Hello, welcome, and thank you for joining us today for the final webinar in our underwriting webinar series on triple net properties. We know your time is very valuable, so this webinar will only be 30 minutes, but will be packed with information with a discussion hosted by President of National Asset Services, Karen E. Kennedy. She is joined by two expert panelists, broker Nick Principe and attorney Paul Rubenstein. If you have any questions for the panelists, please submit them by using the Q&A feature on Zoom. And per usual, let's get a quick disclaimer out of the way. NAS Investment Solutions, Inc. is not a tax, legal, or financial advisor and did not host or participate in today's event with the purpose of acting in any of those capacities. None of the information that will be shared with you today is intended to be personal advice. None of the panelists here today are establishing any kind of broker-client or attorney-client relationship with any attendee. Everyone's situation is different, and you should always seek the advice and consultation of your own independent tax, legal, and financial advisors before taking any action with respect to your personal financial affairs. So with that, I will hand it over to Karen and our panelists, Nick and Paul.
Hi there, everyone. And as Roxanne said, thank you for taking the time out of your day to join with us. I'm so pleased that I have Nick and Paul together to chat about triple net deals. And I think that we should start by just identifying what is a triple net deal, because what is a triple net to some is a double net to others. So Paul, you want to take the lead on that one?
Sure, I'll get started. Triple net typically refers to a situation where the tenant has the entire obligation to maintain the property, replace the property, if there's damage or destruction, to fix that and repair it and pay for it. There are slight iterations. Sometimes a triple net lease will still require the landlord to replace the roof, for instance, or replace load-bearing walls if there was ever that kind of problem. But typically, the tenant bears the full responsibility for maintenance, real estate taxes, insurance. In other words, the landlord can assume that the rent it gets, it will keep and will not have any significant operating expenses that get applied to that rent.
Exactly. Okay, so with that as a backdrop, everyone, I think that we should dive in with what are the most common mistakes that are made in underwriting said triple net deals. Because if there's a problem in the underwriting, often that it is missed or shaded, it can backfire on the investors during their hold period, make it very difficult for them to exit properly. And for those of you who know me, you've heard me say many times, you make your money when you buy your deal. You realize what a good decision it was when you exit. So, and you get your checks throughout the hold. So with that, Nick, do you want to talk a little bit, start us off on
Sure.
What are the common mistakes?
I think the first thing that we look at when we're underwriting a deal is one that most investors do not really pay attention to. Most of the investors are looking at how much cash return am I going to get on my investment? What's going to be my yield? The real trick, and the one thing you should always remember as the key for this business, is at the end of the time in which you made this investment, can you sell the property for the same price or more than you originally paid for it? There are so many things that impact that decision. Is the tenant any good? Is the area changing? These are underwriting mistakes. Everybody thinks about location, location, location. But the typical triple net investor never visits the property, doesn't know anything about the town, and is just looking at who the tenant is. So the location issue, you better leave that up to the sponsor or some other alternative method of assessing it. So it's primarily, what can you do when it's time to sell the building? Is it as good or better than when you bought it? Is the tenant stronger? Is the market better? Is the building, it's 10 years older, 5 years older. It could already be 20 years old, and by the time you get to sell it, it's 30. You think that makes a difference? I think so. The key for me, and when we underwrite stuff, the most important thing, as I said from the beginning, can you sell it for the same price or a greater price at the time you're ready to harvest this investment?
Do you see now that lenders are looking at it differently? How do they look at it? Do you have a sense? Can you share what your sense is on how a lender looks at the due diligence and how they view what you were just talking about? Because let me just stop there. Paul, do you want to?
Well, yes. And to pick up on what Nick was saying, most investors, when they look at an investment opportunity, are concerned first and foremost on their return. What over the course of the investment, are they going to get their checks every month, and what interest, what return will they get? When a lender looks at it, the lender is looking at it from a catastrophic standpoint. How certain are we that our loan is going to be repaid? So they're always looking towards the end, where the investors are looking, as Nick said, sort of from the beginning. And so what you see from a lender standpoint at this now is they're looking at it in a much more granular way than the typical investor would. They will look at things like, what are the sales per square foot of a specific, the store you're looking at doing, whether it's a Walgreens or a CVS or whatever kind of investment it is. They are going to try to get much more into the weeds to determine that this is a store that's going to be there, that's doing well, that frankly, even though you may be buying this with a 10-year due date on your loan and say 13 or 14 years left on the lease, there's almost always renewal options, and the lender will factor in, will we have, when it's time for this property to be sold, will there be enough lease term, and is the probability of a renewal good, so that we know that there are going to be buyers lined up to buy this at the end of the term.
Right. Because if you don't have enough term remaining when you go to sell, then you limit your buyer pool coming in to take on what you had been enjoying over the years.
Right. And just to make one more point on this, perhaps 5 years ago or 3 years ago, the lender's investigation might have basically been completed once they looked at the credit rating of the tenant and looked at the lease to make sure there were no outs or traps in the lease. Now they are much more concerned about underwriting the actual performance to make sure that the store is actually performing and that the tenant is not going to have any incentive to try to shorten the term or not renew, or that it's just an underperforming asset for them. The lenders are much more careful about trying to make sure that this is going to be a well-performing asset, not only for the investor and for the lender, but for the tenant as well.
Right. They actually check out the comparable market rents and compare what the tenant is paying for those at the market rents, even though those tenants may be paying something that at a the delta between the two. I'm holding my hands up, but you can't see. The delta between the two is quite large. but they are they're really focused on, is it too great of a difference? How would they backfill if they were in that position? Because they've taken back a lot of property, and so the next thing that comes to my mind is what really qualifies as a credit rated tenant. That term is used very loosely by a lot of people. As investment grade, or it's a highly, desirable credit tenant. Obviously, somebody who's in an essential business, which is a term that we've only started to grips with since COVID, that's a whole other factor that has come into play. But leaving COVID aside for a moment, we'll come back to that. What do you think a lender is looking at and an investor is looking at, and are they the same?
Nick, you want to take a shot at that one?
I think the difference to me is the investor wants to make sure he's going to get his return, and he's less concerned about what happens at the end, at the present time. The lender just wants to make sure he's going to get their money back, the whole amount of their money back, and they don't get stuck owning the property and having to refill, as you said, Paul. I mean, to put another tenant back in, it's not free. The tenant just doesn't take what's there. You've got to spend money. The other thing the lender will look at is that it's nice to have a tenant with renewal options. But any smart tenant, when it comes time to renew, they're going to say, oh, I'll renew, but I need a new roof. Or you need to fix my parking lot, or the rent's high,
or lower my rent. Right?
Yeah,
right.
So there is a difference between what the lender's worried about and the investor worried about their monthly cash payments. As I said before, the disposition of the property is probably more important than the cash that you're getting. Because if the property turns out to have less value, it's going to discount all the money that you've gotten in the meantime, and you're going to lose 10 or 15% of your equity, and you really didn't make the yield. And you have to really look hard at this. The due diligence is wide ranging. I mean, it's the neighborhood. It's the type of customers. Is the business still going to be there? Is the retailer going to get sold to someone else who changes the use? Some big office companies, they'll get bought by someone else and grow too big and can't stay in the building. So you have to look at what's going to be the cost to replace that tenant if you need to do that along the way.
Right, and also checking out with the city, because sometimes the city will come in and it's usually if you're at a hard intersection, you want it to be signalized. You want it to have a pocket for a left turn lane. You want all of those things already in play that line up with making circulation and access easy. But the city can come in and condemn and take back some of it if they have to widen the street that really should have been wider. And so you need to look at all of that when you're buying to make sure that the investment is going to be held intact and improve over in your crystal ball over the 5, 7, 10-year hold.
One of the things that's changed immensely is over the past several years, the basic retail businesses have been very hot triple net investments. People love to have the retail businesses. The credit was really good. And now they're finding out that even though they had good credit, I mean, there have been examples of Starbucks, which has great credit, who just stopped paying rent in some of their stores. Mm-hmm. Didn't have any customers. So,
or that they had a kick out in their lease. They could a kick out meaning to say that they could terminate with no notice, no obligation to remain, even though they're a great tenant. They could terminate, they could kick and walk away from the deal unscathed. And there's the owner sitting there, and the owner didn't read the lease, which is so cool.
That's a great point, Karen, because I'm actually, on behalf of another client, negotiating a Starbucks lease as we speak. And probably the hardest thing we've negotiated is on what terms they can kick out early because they now demand they will not sign a lease unless they have some kick out right. So what we've negotiated on ours is that they have to give us a minimum of 4 years rent if they want extra
4 years?
4 years. And our lender has said that they were okay with that they would underwrite it as it was a 15-year lease, and they would underwrite it that way as long with a 4-year kick out. So.
And a drive-through, I hope.
And a drive-through.
Of course.
Absolutely. But I want to pick up for a minute on something Nick said, which is what COVID has done to expose certain tenant groups that we thought were great. And I think uncover certain tenant groups that had really been kind of in the weeds and underappreciated and undervalued. So things like retail, frankly, large office, all of those have been exposed to some extent as having some weaknesses that nobody appreciated, and it's unclear how long or if at all they will fully recover. It'll take for them to fully recover. But on the other hand, it's shown certain other kind of less publicized companies like logistics and companies that are involved in just basic infrastructure rebuilding and maintenance are really strong companies that survive this kind of stress quite well. And they're not, yes, everybody knows who FedEx is and everybody knows who DHL is, but there's a large number of other companies that have terrific sales and gross income that just fly under the radar. And I think that those are going to get a lot more attention in the future.
And the cap rates on those will reflect that as the market recognizes them, right?
Absolutely.
Nick, can you talk for a bit about cap rates?
Yeah, this is a very interesting part of the business today because the cap rates have come down significantly over the last 3 or 4 years. And I mean, we're talking about businesses that were selling things at a 7% cap rate. And it got to 6. And now there are very few deals available anywhere with whatever type of tenants they're always 5.5, 5. And in fact, Chick-fil-A and some of these other fast food places are like 3.75%. I mean, it's an amazing change of venue. And the investors are slow to recognize that those 6 cap deals are not there anymore. They're really looking at 5 to 5.5% yields. And that's what they're going to be expecting. They're very secure. I mean, for example, 3% is unheard of. 4% a year.
Except for that billboard deal. Remember that stupid billboard deal that floated around? That was crazy. Ladies and gentlemen, there was a billboard that was being sold, an electronic billboard near an interstate, which had all kinds of other issues associated with it. But it was at a sub-3 cap. I mean, for an electronic billboard, can you imagine what the technology changes will be in 5 years, let alone 10 years on that billboard? What? I hope nobody on this call is buying into that deal. Oy.
Another interesting thing is that there is currently a lot of freestanding bank buildings for sale as triple net. The problem, the credit's great. You got a bank. You think it's great. But the banks decide they're going to close that particular branch. They'll pay the rent. But what are you going to do with it? It's built for a bank. It's got a vault. It's got this or that. You can't really turn it into many other things. It's very hard to make a nice retail or an office space or a medical building. You're stuck with the bank. You had good credit. You don't have to worry about the credit because they're always going to pay the rent. But you need to worry about what you do with the building at time for renewal. They're saying, we're not renewing, we're leaving.
I wonder how the lenders are looking at those now, Nick. They probably are finding it difficult and rating it or asking for TI and LCs, right, to pay for commissions at the end because they figure that the bank won't be there.
But one of the things, back onto the cap rate business, if the investors who are buying something are looking at a deal that has something above a 6% cap rate, the warning flags ought to come up because there's something wrong with the deal. Maybe the leases are too short. Maybe the tenant is a bit shaky. There's always something because the market is too efficient. For triple net deals, it's a very efficient market. So if you see something over 6%, you better take a hard look.
Yes, I would agree. Yeah. Let's see, what am I missing? Are there things in due dili that people should be paying more attention to that they don't? I can tell you one thing from my perspective. The property condition report, the appraisal, all of those third parties are paid for by the borrower, but they are for the benefit and reliance of the lender. And so a property condition report comes back. I can never trust what they say because they're so heavy on disclaimers that they're not even worth the paper, I think, that they're written on. And I pay and have someone I trust go out and look at property that's their specialty. And they see things that are wrong that were missed by property condition report groups. It's very disconcerting. It's very disconcerting because you want to believe the third parties, especially when I have to pay for them, but I can't trust them. Are there other things like that? Do you think that, what is your sense?
I think that one of the things that you look at, you have a triple net deal, meaning the tenant should be repairing everything in the buildings. You have to be careful, though, when it gets down to the last 2 years of their lease, before the renewal, they may not fix things that should be fixed. They want to save their money, and they'll leave that to the landlord, have to fix that later. So even though you have a real triple net deal, it doesn't necessarily mean it's been kept up to perfect shape. And it's going to be an expense when you come to sell it. The new buyer is going to look at you and say, hey, those air conditioners, they're 30 years old.
Yeah. And the parking lot, right? We send people out during the hold period. We inspect property and manage the lease and put tenants on notice throughout the hold period so that it's not a big surprise. And we hold their feet to the fire on what they agreed to in their lease.
And that's really key, Karen. And because you also, we were talking a little bit about what kinds of provisions we should look for in the lease. And on a triple net lease, it is critical to look at what the standard is for that the lessee has to leave what kind of condition the lessee has to leave the property in. And I don't think people paid a whole lot of attention to that in the past for many reasons. One of the main reasons was because they weren't getting to the ends of the terms of the lease yet. But now we
it was going to be somebody else's problem, right?
Yeah. So, but now we start to see what happens as you get towards the end of a long-term triple net lease, and you have provisions that say, normal wear and tear accepted. Well, what does that mean? What kind of condition are they actually giving the building back to you? I had the other point is that it's also the red flag for when a tenant isn't doing so well, because the first thing they will try to save money on is deferred maintenance. And I had a situation like that with where we had some triple net lease industrial and warehouse, where all of a sudden things like heaters weren't being maintained properly. and they would open the windows. And we ended up in, threatened major litigation before we finally settled a multi-million-dollar claim with the tenant over the way they were maintaining the building. So that is a key, and doing regular inspections is very important.
This brings up a point.
Go ahead.
All of these things are, for the typical investor, fairly complicated. And I would say that a portion of their due diligence on any investment, they ought to be taking a really hard look at the sponsor and the person who is promoting the deal. Have they been there? Have they looked at the property? Have they done this before? What's the history of the management company? What's the history of the sponsor? It's probably because most investors are not going to go there and not going to look at the building. And in fact, they're not going to read the lease very carefully. So you really need to depend. That's where your due diligence is more important than you can imagine, is the sponsor themselves.
I would agree. Even as a sponsor, I would agree. Having worked for others and having taken over from some of the bad guys who shall remain nameless, so that I don't need to call Paul because I slandered someone. But if you tell the truth, it's not really slander, is it, Paul? Okay, so I have a question, because I think I'd be remiss if we didn't talk about COVID for a moment. I'm sick to death of talking about it and living with it, as we all are, but are there things that are showing up in contracts and negotiations, et cetera, that have to do with the aftermath and fallout from COVID that didn't exist beforehand? I can tell you that, as a sponsor myself, we have extensions that we ask for and pay for if we need to pull triggers on them as we're getting ready to close, because we don't know what's going to happen. We don't know that everybody's going to, everything is going to line up correctly. The third parties, maybe they were late, or there's any number of things that can happen. Nobody expected a pandemic, so there you go. But what are you seeing in contracts, Paul, that is brandy new to you?
Well, I think you've hit upon probably the most important one, which is the level of difficulty in just going through the acquisition process has been increased by a significant amount. And therefore, you have to try to build into the contracts enough leeway so that you can still do the kind of thorough job that you have to do in order to be confident, that this is a asset that you want to acquire. So whether it's additional time, you have to build in additional time for people to physically get to someplace. You can't just assume somebody can jump on a plane and be somewhere. Right. So there's that. The other thing that I've seen, and again, it's seeping into the whole underwriting process of what class of assets are likely to survive well, and that we will be less concerned if we have this again, because yes, this was a once in 100-year event, except maybe now it's a once in every 10-year event, and we just don't know.
Yes, you're right.
I've also seen instances of where people are having trouble getting titles recorded, loans recorded, because there's no one in the little local office to do it.
Oh, that's right. That's right. Yes. Well, Roxanne is pinging me, telling me that our time has run out, gentlemen. Roxanne, I hand it back to you, my dear. Thank you all for dialing in.
All right. Thank you, guys. Thank you, Karen, Nick, and Paul. And thank you to the viewers for submitting these questions. A recording of this webinar will be available on our website in a few days. That's nasinvestmentsolutions.com. And you'll receive a brief survey via email after the webinar, and we hope you take a minute to let us know your thoughts. Thank you.